All right, so welcome back to the deep dive. Today we're going to be looking at Star Health and Allied Insurance. Kind of a deep dive into their recent performance and where they see the future heading.
Sounds good.
We've got the transcript from their Q3 and 9-month FY 2025 earnings call. This took place on January 29th, 2025.
Okay.
And we're going to kind of pick apart all the interesting insights, about their business, how their different segments are performing, what their view is on the broader industry, where they see things heading. And what are the key challenges they're facing? So we'll be hearing from folks like Mr. Anand Roy, who's the MD and CEO, and Mr. Nilesh Kambli, the CFO, among others. And I think one of the things that makes this particularly interesting is that, there are some evolving regulations, in the insurance industry.
Yeah.
One of the big ones is this new 1N accounting method for long-term policies.
Right.
Which kicked in last October. And then also there's this upcoming shift to IFRA. And both of these really are kind of aimed at, greater transparency and a stronger focus on the customer. So where should we begin to kind of get a sense of where Star Health is at right now?
Well, I think a good place to start would be their business segments.
Okay.
Looking at how the different parts of their business have performed over the first 9 months of the fiscal year.
Yeah.
That'll give us a foundation for their overall strategy and where their strengths lie.
Okay, great. So looking at those numbers for the first 9 months of FY 2025, Star Health reported an overall gross written premium, GWP growth of 16%, but that's when we exclude the impact of that new 1N accounting.
Right.
What's interesting is their fresh GWP, which is the premium from new policies. That grew even faster, 27%.
Okay.
Using the same kind of measure. Now let's break down those key segments. Retail health, which is obviously a big one for them, saw an overall growth of 14%. And a pretty robust 22% increase in fresh GWP.
Yeah.
What's really striking here is their market share in retail health, a very significant 32.2%. And they actually highlighted that's 3 times larger than their nearest competitor.
Wow.
Yeah, it's a pretty dominant position.
Yeah.
They also, achieved 13% growth in the number of new retail health policies. So, really focusing on both, how many policies are sold, but also the overall value of those policies.
Right.
And it looks like they're getting better at keeping their customers too. Their fresh to renewal ratio increased to 24.76 from 22.78 in the same period last year. So, building a kind of a solid base there.
Interesting.
And all of this kind of underscores their risk first, growth later strategy.
Right.
Which seems to be, really about building a solid and sustainable business.
Yeah, that makes a lot of sense. I mean, that focus on retail health is really interesting. And it kind of reflects what we're seeing in the market overall. I mean, that improved fresh to renewal ratio, that's great news for them, right? It shows that customers are sticking around, could lead to lower costs for acquiring new customers down the road. That whole risk first, growth later approach.
Yeah.
That's smart too. I mean, it suggests they're not just chasing big numbers. They're focused on underwriting quality, making sure they're actually profitable.
Right.
It's a sign of a more mature business, I think, than just going for crazy growth at any cost.
Do you think that focus on quality over quantity could mean they might see slower market share gains?
That's a great question. Compared to competitors who are, maybe more aggressive.
And maybe taking on more risk.
Right, exactly. It's a trade-off, isn't it? Now, they also talked about what they call their 4 engines of growth.
Okay.
And they've helpfully labeled these A, B, C, D.
All right, let's hear about them.
So first up is agency, the traditional agency model.
Yeah.
And this remains a powerhouse for them. Contributed about 80% of their total business in those first 9 months.
And they have a massive network of agents, 761,000 agents. And they added 19,000 just in the December quarter.
That's a lot of growth.
So agent recruitment for the first 9 months was 66,000. And this channel delivered a really solid 14% growth in fresh GWP. Agent activation also grew by 13%. So, it seems like this traditional agency model is still, really important for them.
Yeah, it definitely shows the power of that channel, for reaching a wide range of customers all across India and those big growth numbers, both in the number of agents and how active they are. That tells me their strategy is working. But we got to remember that this channel usually means higher commission costs compared to digital or bank assurance.
Yeah.
That could affect their overall expense ratio.
That's a really good point. We always have to think about the costs involved. So next up is Bunka, their bank assurance channel, which contributed 8% to their business in the first 9 months. And this segment saw a really impressive 20% overall growth.
Yeah.
And they've actually expanded their partnerships to 69 banks and financial institutions, including some new additions like Bajaj Finance and Neo Growth. which they added in the last quarter. So, BACA seems to be a rapidly expanding part of their strategy.
That's a big jump.
Yeah, it is.
It probably shows that more and more people are comfortable buying insurance online.
Yeah.
We're seeing that trend across the board in finance. And it tells me that Star Health's digital initiatives are gaining traction. It could be a lower cost distribution channel for them over time. We should keep an eye on how this affects their expense ratios and their profits in the coming years.
That's really smart. Yeah. So the good reminder that the landscape is always shifting.
Absolutely.
Then we have corporate.
Okay.
Which is currently contributing a smaller 4% to their overall business. They mentioned this proprietary SME calculator for intermediaries, which seems to be helping them generate new business, specifically targeting, small and medium-sized businesses. So it's a smaller piece of the pie, but clearly paying attention to this segment.
Yeah, focusing on that SME sector within their corporate business is a smart move.
Yeah.
It's a market with specific needs, and they're evolving. And having a tailored approach like that calculator could really give them an edge over the competition. I mean, the SME market in India, that's a huge potential for growth.
Yeah, absolutely. So finally, we have digital.
Okay.
Which also contributes about 8% to their business. And within that digital business, a very significant 72% comes from their own direct-to-consumer channel. The other 28% is coming from online brokers and web aggregators. Mm-hmm. And this segment saw a really strong 58% growth in fresh business.
Wow.
So, that direct-to-consumer approach seems to be really working for them.
Yeah, no doubt about it. That growth in their digital business, especially direct-to-consumer, that shows how comfortable people are getting with buying insurance online. And it makes sense. It usually costs less to distribute that way. Plus, they have more control over the customer experience and what products they offer. That 58% growth is impressive. It really shows they have a solid digital strategy.
So we see they're really, relying on that agency model, but they've got these significant growth areas in banca and digital. So now let's kind of zoom out a little bit. What do they share about the overall health insurance landscape?
Right. So according to them, the overall health insurance industry in India saw pretty healthy growth, 11% in the first 9 months of FY 2025, reaching a total market size of 4,908 crore rupees.
Wow, that's a big number.
It is, yeah. And that growth was mostly driven by retail health, which expanded by 14.3%. And group health also saw respectable growth, 12.4%. Now, they made it clear that these numbers are presented on a 1N basis to align with that new framework for long-term policies. It ensures that everyone's reporting is consistent and comparable across the industry.
Yeah, they really emphasized using both the 1N and without 1N figures. Mm-hmm. For clarity, given those new regulations, a bit of complexity, but I appreciate their transparency. So looking ahead, what's Star Health's perspective on the future? And, what are their plans for growth?
Well, they seem pretty optimistic about the future. They specifically mentioned that January growth in Q4 of FY 2025 was looking very positive across all their retail areas. Okay. And that gives them confidence that they'll finish the year strong. A key part of their growth strategy is their new Superstar product.
Oh, yeah.
This product's designed to be really flexible and customizable with 21 optional covers on top of the core policy.
That's a lot of options.
It is, yeah. And they were really highlighting the unique benefits, like the option to freeze your age for premium calculations.
Interesting.
Limitless care options, a Superstar bonus, a whole wellness program, and even a premium waiver in certain circumstances.
That Superstar product sounds like a really big deal.
It does, yeah.
They seem pretty excited about it. And they even mentioned it's become their top-selling product, both on their digital platform and with leading aggregators, which is pretty remarkable.
Yeah, so soon after its launch. That quick success suggests they really hit the mark, with what customers are looking for. More flexibility and more comprehensive coverage. This new product looks like it's going to be a key driver for their future growth.
Yeah, absolutely. But beyond that specific product, their overall strategy seems to be about achieving both volume and value-led growth.
Made sense.
They've also seen an increase in the proportion of long-term policies in their GWP, reaching 10% without considering the 1N framework. So, that indicates that they're really trying to build those long-term customer relationships and more stable revenue streams.
Yeah, that's a good sign for long-term investors, if they can keep those customers round.
Exactly. Yeah. Another interesting point is the increase in the average sum insured of their new policies.
Yeah.
which has gone up by 10% to 10.6 lakh. And policies with a sum insured of 5 lakh and above now make up a very significant 82% of their retail portfolio.
Yeah.
So it seems like they're really focusing on higher value policies.
Yeah, it seems like they're being proactive with their pricing, too.
Yes, they are.
I mean, they said they've increased prices across about 65% of their retail health portfolio. That's 5 of their core products. And they're aiming for an annualized yield of 10 to 12% on their product pricing, which makes sense. You know, healthcare costs keep going up.
Yeah, it's a necessary move, I think. And, zooming out even further, their big goal is to double their top line from FY 2024 to FY 2028.
Ambitious.
Yeah, it's a pretty big target. And this aligns with their anticipated transition to IFRS accounting standards.
Right. So IFRS, that's a different way of looking at their financials. It's about recognizing revenue and expenses over time. Right now, they might recognize some costs up front, but IFRS wants to match those costs more closely with the period the policy actually covers.
Okay.
So this deferral of acquisition costs under IFRS is going to give a smoother picture of their profitability over the life of those policies, which is helpful for investors who are in it for the long haul.
Yeah, absolutely. Now, of course, no deep dive is complete without talking about the risks.
Of course not.
And challenges. What were some of the key concerns that they brought up?
Well, one of the biggest ones was their loss ratio
Okay.
for the first 9 months of FY 2025. Their overall combined ratio, using that 1N method, was 101.8%, higher than the 98.3% they reported for the same period last year.
Yeah.
Now, if you look at it without the 1N impact, the combined ratio was 101.3%, and their claim ratio also increased to 70.7%, compared to 67.3% in the previous year. Specifically, their retail loss ratio was 69.2%, while their group loss ratio was a lot higher at 90.4%.
Okay, so that increase in the group loss ratio, that's pretty significant. What did they say was causing those higher claims?
They said it was a bunch of things. More people making claims, and the average cost per claim going up, what they call severity. They also talked about easier access to cashless treatment, hospitals being more proactive about reaching out to potential patients,
Okay.
and more people choosing surgery over less invasive options.
So it's like a perfect storm.
Yeah, a bunch of factors all coming together, affecting both how often people claim and how much those claims cost.
So what are they doing about it? I mean, these elevated loss ratios?
Well, they're doing a few things. First, those price increases we talked about.
Right.
Those should help improve their profitability. As those new premiums come in, they're also getting more granular with portfolio correction. It's called micro-segmentation. Basically, it's about understanding the risks in much more detail and tailoring their prices and products accordingly. They're also working on supply-side management, which means negotiating with healthcare providers to keep costs down. And even though their group business has a high loss ratio right now, they're going to keep focusing on those SME and mid-corporate segments, but with stricter underwriting and price adjustments.
Okay, so it sounds like they have a pretty solid plan to address this.
Yeah, a multifaceted approach.
What about their expenses? What do they have to say about that?
Their expense ratio for the first 9 months of FY 2025, using 1N, was 31.2%, a little higher than the 31% from the same period last year. Without 1N, it was 30.6%. Now that increase under 1N, that's mainly because of the way gross written premium is reported.
Okay.
It affects the bottom part of the expense ratio calculation, but they stress that their underlying operational expense ratio is basically flat, and they think it could even improve as they get bigger. And their banca business grows, which usually has lower acquisition costs.
So basically that increase in the expense ratio, more of a technical thing, because of the new accounting rules.
Not because they're spending more on their operations.
That's a really important distinction.
Absolutely.
So besides this 1N thing, are there other regulatory changes that are, creating challenges or opportunities?
Well, the implementation of 1N itself, that's a big change. As we've talked about, it reduces the reported gross written premium.
Right.
Because premiums for long-term policies are now recognized annually instead of upfront. Now they use something called a 1365 unexpired risk reserve method.
Okay.
This basically makes sure that the part of the premium that hasn't been earned yet, because the coverage period hasn't happened, is accounted for correctly. It's technical, but the main point is that even though the way GWP is reported changes under 1N, the actual revenue they recognize over time stays the same.
Okay, that makes sense. And IFRS.
Yeah, that's another big one. They think it'll make things clearer. When it comes to key financial metrics, like net earned premium investment income acquisition costs, And under IFRS, those net acquisition costs get spread out over the life of the policy, which they believe gives a truer picture of the returns on their investments. They also mention the expenses of management regulation, which puts a limit on how much standalone health insurers can spend. It's capped at 35% of GWP, and Star Health is well below that limit right now, which gives them some flexibility.
So it seems like these regulatory changes, they make things a bit more complicated in the short term.
Yeah.
But they're ultimately meant to make the industry more stable and transparent.
Exactly.
You mentioned earlier those challenges in their group business. Were there any other specific risks that they highlighted?
Yeah, they talked about the risks that come with raising prices, which they're having to do because of medical inflation.
Right.
They know that if customers get too sensitive about price, it could hurt their market share. But they're being careful. They're watching how customers react, and their goal is to get an annualized yield of 10 to 12% per product. So they're trying to strike a balance between profits and keeping customers happy.
Right.
The good news is their retention rates have been pretty good, even after past price increases.
That's encouraging. What about the bank assurance slowdown?
Yeah, they did mention a slowdown in the PSU bank channel, which is part of their bank assurance business. They think it's because of some recent regulations and more oversight in that sector. But they're still positive about bank assurance overall. They see potential for growth with both their existing and new partnerships.
So it's a real balancing act, isn't it?
It is.
Managing those rising healthcare costs, trying to keep their market share, and adapting to all these changes in regulations.
Yeah.
Especially in bank assurance. Sounds like they have their work cut out for them.
Yeah, it's a complex situation, lots of opportunities, but also plenty of challenges.
Okay, so let's wrap this up. What have we learned? Well, we've seen that Star Health's retail business is still going strong, mostly thanks to their big network of agents. But their banca and digital channels are growing fast. The health insurance industry as a whole is showing good growth. And Star Health seems optimistic about the future, especially with that promising new superstar product. But they're not ignoring the challenges. They're tackling those high loss ratios, especially in their group business, with things like price increases and portfolio adjustments. Plus, they're dealing with all these regulatory changes, like 1N accounting, and the upcoming shift to IFRS. Those changes might make their financials a bit harder to understand in the short term, but the goal is to make the industry more transparent and stable.
Yeah, long-term thinking.
And the company seems confident that they can hit their ambitious target of doubling their top line by FY 2028, all while managing these challenges.
Sounds like they have a lot on their plate, but they seem to be handling it well.
Yeah, they do seem to have a good grip on things. So that's our deep dive into Star Health and Allied Insurance's latest earnings call.
Thanks for walking us through it.
Now here's a final thought for you to chew on. Healthcare costs just keep rising, and that obviously affects insurance premiums.
A big issue.
So what kind of really innovative, maybe even unconventional solutions could we come up with to make healthcare more sustainable and accessible for everyone?
That's the million-dollar question.
It is. Can we go beyond those traditional insurance models? What about technology? Preventative care. New ways for insurers, healthcare providers, and regulators to work together. It's a big challenge. And the best solutions might come from the most unexpected places. Thanks for joining us on the Deep Dive. We'll see you next time.